Black Gold Temptation of Wall Street, Episode 3, Interest Rates, Earnings, and China: How Wall Street Players React. Another volatile day on Wall Street. Where is the market heading? To break it down, let's hear from James first. James, can you analyze today's market trends? This is James. Absolutely. The Dow Jones rose 0.8%, but the Nasdaq dropped -1.2%, and the S&P 500 remained flat. This split performance was mainly driven by the Fed's stance and global economic concerns. Recently, the Federal Reserve announced that interest rates will remain unchanged. However, unlike market expectations, the Fed did not hint at any dovish pivot. Instead, they emphasized that inflation is still above their target, signaling continued tightening. As a result, bond yields spiked, and growth in tech stocks suffered the most. Another major factor was the weak Chinese economy. The Chinese manufacturing PMI fell to 48.2, indicating contraction, which spooked investors. This also impacted the commodities market, worsening market sentiment. As a result, risk-averse behavior increased across Wall Street. As James mentioned, we are in turbulent times. How should investors react? Jane, what's your take on this situation? This is Jane. James is right, the market lacks a clear direction. But volatility also creates opportunities. In the M&A sector, defensive mergers are becoming a dominant trend. Companies are prioritizing survival strategies rather than aggressive expansion. Investors should keep an eye on potential M&A targets, as they could become the next hot assets. Another key driver is big tech earnings. Tesla (TSLA) is struggling with declining sales, leading to a 7% stock drop. Apple (AAPL) also took a 3.5% hit due to slowing sales in China. On the other hand, banks like JP Morgan and Goldman Sachs are benefiting from higher interest rates. In this market, it's crucial to identify solid trends and allocate assets accordingly. Defensive asset allocation is becoming more critical than ever. That's insightful. Finding balance is key in a volatile market. Now, let's turn to Sophia for a quantitative trading perspective. Sophia. This is Sophia. Hi, this is Sophia. I approach the market through data-driven strategies. Currently, our Quant models are detecting a surge in volatility for tech and growth stocks, making short-term trading more favorable over long-term positions. AI and semiconductor stocks are facing heavy sell-offs. NVIDIA plunged 6%, AMD and Intel fell by 4.5% and 3.8%, respectively. However, pattern analysis suggests that tech stocks may form a bottom within the next 3 weeks. Given this setup, investors should prepare for further pullbacks while shifting towards defensive sectors like finance, defense, and energy. Holding more cash in such an environment can also be a smart move. In summary, extreme volatility continues to dominate the market. The key is to stay defensive while strategically taking advantage of trading opportunities. Now that we've analyzed the market, let's discuss investment strategies that work in these conditions. Each of our experts will explain their approach. Let's start with Jane, our M&A specialist. This is Jane. M&A isn't just about corporate takeovers, it reshapes entire industries. Due to rising interest rates and economic slowdown, companies are prioritizing defensive mergers over expansion. Investors should track potential acquisition targets, especially in healthcare and cloud infrastructure, as they tend to remain stable even during downturns. Interesting perspective. James, what strategies do hedge funds use in this environment? This is James. Hedge funds thrive in volatility. One of the best approaches now is long-short trading. For example, before a big tech earnings release, short sell high-risk stocks. Once the report triggers a sell-off, cover your short and go long at the bottom. With major economic events coming up, short-long trading is the best way to profit. Additionally, using Quant models and AI for short-term trend detection is becoming a major edge for hedge funds. Finally, Sophia, can you explain Quant trading strategies? This is Sophia. Quantitative trading is purely data-driven, free from emotional bias. The two key indicators right now are the VIX Volatility Index and institutional investor flow. Recent data shows institutions are shifting away from tech stocks into defensive assets. The best strategy now is to focus on dividend stocks for long-term stability while utilizing option trading for short-term volatility plays. Quote, great insights. Instead of predicting the market, adapting to its movements is key.